So the recent resiliency of the global economy has certainly been something we've spent a lot of time thinking about. So a little bit of context in the sense of what we've seen already from interest rates. So we've seen a very dramatic increase in interest rates over a very short period of time. And the working assumption is that that higher cost of capital would really start to slow economies around the world. And if there's one thing that I think has caught the market and investors off guard as we are at the halfway point of 2023, is the very fact that the economy has actually stayed relatively strong. And we spent a fair bit of time thinking as to why this is the case. And I think a large part of it comes down to the pool of accumulated savings that households have enjoyed. So part of that, I think, is the very tail end of government stimulus that was provided through the COVID pandemic. But an important part of it also comes through the wage channel. So as we've seen, labor markets have stayed very tight. And as a result, wages have remained elevated. And that's given households a fair bit of support to weather the cost of higher interest rates. So as we think about that pool of savings, it inevitably is still temporary. So at some point, that pool will be drawn down, and then the true burden of higher interest rates will unfortunately be felt in the economy. And when we think about how that influences the market, certainly expectations that the economy has stayed strong has allowed the market to expand and equity markets to do well. But I think, again, that will ultimately prove to be temporary. So from our perspective, how we are positioning our funds, we're still leaning towards a defensive allocation, recognizing that the interest rate drag on the economy will eventually be felt. And that's something that's not currently priced into how financial markets have performed thus far.